Dear all, good day and welcome to the conference call. It gives me immense pleasure to share an important update with all of you about demerger. As you are already aware, on 1st of April, our board had directed the management to evaluate the proposal of a restructuring exercise. Pursuant to that, this Friday, 19th April 2024, the board of Aditya Birla Fashion and Retail Limited has approved the proposal of vertical demerger of Madura Fashion and Lifestyle business from ABFRL into a newly incorporated company named as Aditya Birla Lifestyle Brands Limited, which will be listed separately post the demerger. This demerger will enable creation of two separate listed entities as independent growth engines, possessing distinct capital structures and parallel value creation opportunities, thus unlocking significant value for the shareholders through independent market-led valuation. On receipt of necessary approvals, the demerger will be implemented through an NCLT scheme of arrangement. Upon completion of this demerger, as per the share entitlement ratio recommended by the independent valuer and opined on by a fairness opinion advisor, the shareholders of ABFRL will get one share of Aditya Birla Lifestyle Brand Limited for every one share in ABFRL, in addition to their existing shareholding in ABFRL. The business assets and liabilities will be split between the two companies in accordance with the prescribed regulatory framework. In line with the norms, the overall ABFRL borrowing, which is estimated to be approximately rupees 3,000 crore as of 31st March 2024, will be split between the two companies as on appointed date, that is 1st April 2024. As of this date, the estimated date to be transferred to ABLBL, that is Aditya Birla Lifestyle Brand Limited, will be approximately rupees 1,000 crore, and the balance will continue to stay with ABFRL. These will be the opening date positions in two respective companies till the effectiveness of this scheme. Just to clarify further, the NewCo, that is Aditya Birla Lifestyle Brand Limited, the opening date as on 1st April 2024 will be approximately rupees 1,000 crore. Within 12 months after the completion of the demerger, ABFRL plans to raise approximately rupees 2,500 crore equity capital to strengthen its balance sheet and fund the growth of remaining businesses housed within itself. Promoter group will fully support the proposed equity raise in the company. Let me elaborate on the two business segments. As you know, ABFRL currently runs a diverse portfolio of fashion brands and retail formats with key business segments comprising of Madura Fashion and Lifestyle, Pantaloons, ethnic portfolio, along with other new growth platforms. The Madura Fashion and Lifestyle business segment, consisting of 4 lifestyle brands, namely Louis Philippe, Van Heusen, Ellen Solly and Peter England, along with casual wear brands American Eagle and Forever 21, sportswear brand Reebok, and the innerwear business under Van Heusen will be demerged into separate listed entity. Basis current run rate, this portfolio has a combined scale of rupees 8,000 crore on annualized basis. This business over the years has built a leadership position in its segment and has a proven track record of delivering consistent revenue growth, strong profitability and free cash flow generation along with high ROCE. As a separate listed entity, the business will be able to pursue its independent growth and value creation trajectory in a more focused manner. Post demerger, the remaining ABFRL will be an attractive portfolio comprising of multiple distinct high growth platforms in large addressable markets with significant value creation opportunities. The portfolio will comprise of following 4 segments. First, the value and prestige segment, retail play under Pantaloons and Style Up. Second, ethnic portfolio, one of India's most comprehensive ethnic wear portfolio covering multiple occasions, price points and consumer segments, including designer wear partnerships and recently acquired portfolio of TCNS brands. Third, the luxury portfolio, a fast-growing bridge to luxury and luxury platform of the Collective, Galeries Lafayette and select luxury brands. And the last 4, tomorrow a leading portfolio of digital fast fashion brands. This portfolio within ABFRL currently has run rate of approximately rupees 7,000 crore plus on annualized basis and is expected to grow rapidly. To suitably fund the growth of these businesses and to infuse strength in the balance sheet, ABFRL will raise external equity capital of 2,500 crore with backing from promoters. To conclude, over the years, our portfolio has evolved from 4 brands to more than 30 plus brands across various lifestyle categories, mirroring the evolution of our consumers and their purchase patterns. For the next phase of growth in these businesses, we believe they need to be structured appropriately with a simplified architecture that could enable businesses to follow their own growth plans as well as unlock distinct value creation opportunities. The separate structures would sharpen strategic focus and ensure clear capital allocation. The 2 separately listed entities will allow participation of right set of investors and strategic partners in line with the appropriate risk profiles and will encourage better capital market outcomes. The proposed demerger will be subject to necessary regulatory approvals and may take between 9 to 12 months for implementation. Please note that the TCNS scheme, which is already in the NCLT process, will precede the implementation of this demerger scheme. This is the approval of NCLT. Thank you for your time today, and we are happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nihal Mahesh Jham from Nuvama. Please go ahead.
Yes, thank you so much and good evening. Just checking, am I audible?
Yes, Nihal, we can hear you.
So 3 questions from my side. First is, was the trigger of this transaction mainly from a perspective of value unlocking or any other considerations that came to consider this demerger?
You want to ask all 3 questions or let me go at this one first. I think this is... So Nihal, if you look at our business and our trajectory over the last 4 or 5 years, as we had identified the strategy to play in all meaningfully large segments of Indian apparel industry, and as a part of that strategy, we had invested in partnerships, we had entered new segments, we had acquired new businesses, and built a portfolio of multiple large platforms. At the next level of taking these businesses, we needed to raise capital, and we felt the best way to raise capital is to raise capital for the businesses who need capital and keep the businesses who are self-funded, mature in their sense and are able to pursue their own growth trajectory separately. And that led to thinking around separating it to 2 businesses, one which has a clear, proven track record, own ability to raise cash and pursuing its own trajectory, which is the Madura part of the business, and the other business which needs capital, and therefore it's best to raise capital in that entity, which again has very high growth, perhaps even larger growth run and multiple growth opportunities. So that's the rationale for this fund, this structuring.
That's clear, Archie. So a related question to that was that in the future, right to think that Madura would continue to be these core brands, whereas all the incremental ventures into new opportunities would be via the existing ABFRL, which will include Pantaloons and New Avenues. Would that be the right way to think of these 2 businesses in the future?
I think a better way to think about it, Nihal, is we have been articulating and consistently executing on a strategy on where we want to play. We now, as we have said over the last couple of calls, have clearly well-defined canvas in each one of them, very strong assets in each one of them. And therefore, as we look at it medium term of a business, we don't see the need to actually add more vehicles to it. We now have clearly separated the 2 vehicles on where capital is required and where the capital is not required. And I think we can pursue clear independent strategies with 2 companies.
Sure. The final question was, if you could at present give a ballpark split of the fixed assets and working capital and the and the lease liabilities for the two businesses as you've given a ballpark bifurcation for the debt?
So Nihal, we are filing the scheme with the stock exchanges today and in next few days with the December cutoff. But we have worked it out, the date number, approximate date number, as on 31st December 2024, because my audit is still on. So let me tell you, the demerger is under Section 219AA of Income Tax Act. The section sets the framework for split up of assets, liabilities, and borrowings. Borrowings could be specific and for general corporate purposes. In our case, the specific borrowing is relating to only one series of debentures, which will remain in ABFRL. Rest all are general corporate purposes borrowing, which will be split up as per Section 219AA explanation 2C, that is in proportion to assets transferred to the total assets of company. The debt allocation is based on estimated borrowing as on 31st March 2024. That is, I already conveyed, in Madura part of business is estimated to be approximately 1,000 crore against the total borrowing of 3,000 crore. The allocation is also vetted by our tax and legal advisors and certified by auditors.
I think, Nihal, you'll have to wait for our March results post-audit, and you'll have the exact details there.
That is right.
We're trying to give a sense of debt number because that's a singular number on which we have a reasonable degree of visibility at this point of time.
Thank you so much, sir. I'll come back if there's anything. Thank you.
Thank you. The next question is from the line of Devanshu Bansal from NK Global. Please go ahead.
Yes, sir. Hi. Thanks for the opportunity. I wanted to check if we have mentioned that we'll be raising another 2,500 crore of money in the left entity, which is ABFRL. Can you highlight as in what will be the exact purpose of that capital raise? Will it largely be for the debt reduction, or will be remaining with the debt and using it for growth purposes as well?
It clearly is a combination of both. As you know, we have multiple businesses in that segment, and each one of them has very large runway and growth potential. So essentially, the capital raise will fund the growth that these businesses have. And to the extent there is a debt sitting on the book, we'll have to maintain the balance sheet also, so we'll strengthen the balance sheet to that extent.
Mr. Dixit, can you help us understand at this 7,500 crore run rate that we've spoken about for this business? I guess we will still be at a pre-Ind AS EBITDA loss of about 250 odd crores, right, for this part of the business. As in, what is going to be the trajectory of at least operational losses in this part of the business? If you can share some thoughts over that.
We can't comment on that. I don't know which business are you talking about. I couldn't hear you correctly. Can you repeat your question?
Sure, Mr. Dixit. I was speaking about the remnant business in ABFRL. Jagdish talked about that this is currently at a run rate of about 7,500 crores. What my sense is this would still be at a pre-Ind AS EBITDA loss run rate of about 250 to 300 odd crores. I wanted to get some sense if you could help us understand what is the trajectory of profit going to be in this business.
So I think in this call, we are more focused on the structure of the scheme itself. Don't want to give any forward-looking projections at this point of time, but I'd like to reassure. I think the number that Jagdish was talking about was about 7,000 crore of the revenue run rate, which is the current run rate of that business. As far as EBITDA and other numbers that you're talking about, we'll perhaps at some point of time come and talk about the future projections for this business, but we are not talking about it in this call.
Got it, sir. Thank you. Thank you for taking it.
Thank you. The next question is from the line of Tejas Shah from Avendus Spark. Please go ahead.
Hi, good evening, and thanks for the opportunity. Three questions from my side. So first, we always had this ambition of to emerge into a fashion powerhouse in terms of having multiple formats, multiple categories, multiple brands. And then it always appeared, at least theoretically, it always appeared to be kind of appealing and synergistic. So just wanted to know, as the first question is also that the trigger of the transaction, and how do you see that vision getting compromised in terms of operational synergies or sourcing synergies or branding synergies going ahead?
We have always run these businesses, as you know, you are aware of, these are fairly strong organizations by themselves. Each one of the parts of the businesses, whether it is Madura business, Pantaloons business, innerwear business, ethnic businesses, in fact, multiple ethnic businesses in that sense, run by truly comprehensive and complete management teams led by a CEO, each one of the businesses. And the synergy which came through management, came through common best practices, many of those things will be, these are two entities within Aditya Birla Group, and to the extent there is value in synergy, we will be able to extract that. But these are independent businesses, fairly differential business models, different rates, stages of their evolution. And to that extent, I think we felt that it would be more clearer to run them as, and particularly from capital allocation point of view, capital raise point of view, capital deployment point of view, there are two clear segments were emerging. One which had reached both the size and scale and ability to grow and still pursue growth with their own capital, as well as other set of businesses which have very long runway but needed additional capital. And therefore, raising capital together didn't make sense at that point of time, and both had become large enough. And therefore, that's really why it led to this structure. We feel we've been able to manage reasonably good synergies through management cooperation. These are both teams of Aditya Birla Group, and to that extent, we found a mechanism by which the common learning, the best practices, etc., will continue to get shared.
The second question, Pantaloons. So obviously, you kind of justified why it is part of the other portfolio and not with lifestyle brands. But was just wondering, just from the explanation or the definition that you just gave, from ability to self-fund growth, Pantaloons was almost reaching there. So was there any thought that can Pantaloons be part of this portfolio? If, let's say, as an investor, somebody wanted to play mature portfolio of lifestyle brands and Pantaloons together?
Yes, when you do this exercise, you think about multiple combinations of what is the best way to do it. We felt the opportunity for Pantaloons today, which is in a masstige retail segment, and a Style Up that is just under that, and overall opportunity in that segment, combined with the slightly higher capital need model that a retail needs versus a franchisable Madura small brand format, small store format model, we felt that the nature of the businesses is distinct enough, and a long-term need for capital in that segment will continue to perhaps be there as we pursue this opportunity at the next level of scale and size. And we reached this conclusion that it's perhaps best done in this format.
Got it. The last one, if I may, Madura portfolio, lifestyle brand portfolio, always had this imperative to support many emerging projects or emerging initiatives that we had taken on the other end. Now, with most of those being carved out, how should we think about capital allocation philosophy of lifestyle brand portfolio alone going forward?
So Tejas, there also, if you look at it over the last few years, we've done multiple things in the demerged entity that you talked about. The first one, I would say, each of our brands has spent over the last few years significant effort in creating new categories, new occasions. Casualization has been a large theme, and therefore multiple growth opportunities with the four lifestyle brands themselves have come. What we have added to that portfolio is young denim and fast fashion portfolio, as well as Reebok, which are both opportunities by themselves. You know the size of sportswear market in this India, in this country, as well as other brands in the segment. And you combine that with the runway that innerwear business has. You have multiple growth options even in that brand, from the full lifestyle brands to youth casual brands to sportswear space where Reebok plays, as well as the innerwear market. So multiple growth opportunities there. All of them are of the kind that they don't need too much capital and are typically either a small brand format for growth, or which can be franchised far more easily, or in case of innerwear includes wide distribution, which is again less capital intensive.
Got it, sir. Thanks and all the best.
Thank you. The next question is from the line of Varun from ICICI Securities. Please go ahead.
Am I audible?
Yes, sir.
Yeah, sure. Thank you for the opportunity. So my first question is on the line of thinking while we were kind of deciding to bifurcate, which brand to keep in which of the two separate entity. So, for example, why TCNS would be categorized in Aditya Birla Fashion Retail. Whereas I would maybe look at TCNS more as a brand compared to as a retail, and similarly Forever 21 into Aditya Birla Brand Limited. That's my first question.
So I think, well, in our question, our division is not retail versus brands. All brands, typically and increasingly so, are becoming vertically integrated retailers in that sense. So most of the brands are owning their own retail. If you look back 10 years back, the share of retail used to be less in most brands. Increasingly, brands and retailers are difficult to extinguish beyond a point. So our division is not on that segment. We looked at parts of the businesses and nature of businesses which have reached very distinct and I would say well-stabilized state, and the businesses which have high growth potential but currently require capital to come to the stable end. And TCNS is a part of the overall ethnic portfolio, along with the other ethnic brands which either we have invested in partnership with designers, or the brands that we have launched yet, brands like Taswa, are in early stage, and our ethnic portfolio combined with the TCNS entity today is the largest ethnic portfolio in the country today, with close to 2,000, little bit more than 2,000 crores of annualized run rate. And we feel that keeping them together will create a very powerful ethnic portfolio which can both learn from each other and over a period of time can feed into the entire ecosystem, and therefore it needed to be kept together. And that's the rationale for keeping it together.
Okay. Understood. Right. And so my second question is on the how the organization structure in both the company will look like. Will it be similar compared to what we see as on today for both the entities?
At the highest level, Varun, as we said, these businesses for long have been run as fairly complete and comprehensive organization run by fairly seasoned professionals and CEOs and so on. That's part of the overall management philosophy that Aditya Birla Group has for the business. As far as specific independent companies are concerned, during the next 9 to 12 months and closer to the actual demerger, we look at the structure. I think the board will have to take some decisions regarding the management structure, and that will become clearer closer to that time.
Okay, understood, sir. That's it from my side, sir. Thank you.
Thank you. The next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, good evening everyone, and thanks for taking my questions. I have three, and I'll be quick. So firstly, sir, just a broad indicative timeline on this demerger. I know you, Mr. Bajaj, said that it will happen post the TCNS 49% stake acquisition, but just any other sort of guideline as to 6 months, 12 months, how do you envisage when this demerger will play out based on all the set of approvals and requisite things that you need to do?
So Samir, I have said that we will try and complete this process, in next 9 to 12 months time, which include filing of the scheme with the stock exchange. That will happen next week. After that, it will go to NCLT and then the court convened meeting, etc. But court convened meeting we propose to do only once the TCNS approval is in place.
Got it, sir. And second question, sir, in the press release we have written that the promoters will fully participate in the equity raise capital. Just want you to elaborate on what exactly does this mean?
So, Sabir, to some extent, the exact nature of the fundraise is not finalized yet. This is still to be discussed, and we still have time, 6-9 months, to come to exact nature of fundraise. But this basically validates support from the promoter to the next company and the overall ambition which Aditya Birla Group has for its fashion business. It's a reconfirmation of that faith.
Got it, sir. So it doesn't really mean that only promoters will participate. It is still open, and there is a kind of certainty that this 2,500 crore will be raised. If not, the promoters will fully participate. Is that understanding correct?
Yeah. So this is to indicate, one, a broad amount of fundraise that we want to do, and the fact that Aditya Birla Group will be fully behind the fundraise. The nature and the mode of fundraise is still to be decided.
Got it, sir. And last question from me. This net debt number based on FY24, there is a chance that there will be some changes till this process is finalized. So how is that incremental debt, if any, will be split between the two entities?
See, the 31st March 2024 audit is still on. So we have done the calculation. Therefore, I am telling you the approximate number. It will be in a range of around 1,000 crore, right? Not more than that, around that. So after that, this is the opening balance for the new co of on 1st April. This number. After that, they have their own cash generation, and we will run this business in trust for them till the effective date.
So there's unlikely to be a very large deviation, Samir, because we are indicating a number which is close enough to what we see at this point of time, and there'll be marginal up and down which happens in the normal course of final audit, but it's unlikely to be any different.
Got it, sir. That's all from me. Thanks for being very clear in the answers.
Thank you.
Thank you. Next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So there's one question on my side on the leadership structure of both the entities. So we have Vishak, who is the CEO of Madura, and we have Sangeeta, who is the CEO of Pantaloons and Style Up, and both of them report to you. So going forward, how will this structure change?
So just to complete, as we operate today, Vishak heads large part of Madura business, most of the all the lifestyle brands, Reebok, American Eagle, Forever 21. We have a CEO who runs Innerwear, it's Puneet. Sangeeta runs the retail formats in the value and the masstige segment, which is Pantaloons and Style Up. We have a CEO, Satyajit, who runs the luxury and the bridge to luxury formats of Collective International Brands and the proposed Galerie Lafayette project. Our ethnic wear business has multiple CEOs due to the nature of this business. TCNS is headed by its CEO, which is Anand. Suraj heads other designer brands, and we have separate CEO for Sabyasachi. So, as you know, we focus on each of the large business as independent entities with clear management structure. Tomorrow has a separate CEO. Prashant runs Tomorrow business as the CEO. As we go forward, as I mentioned in the earlier response, closer to the actual period, and somewhere between now to next 6 to 9 months, we'll figure out the kind of management structure that will be required to run the two companies separately. There'll be announcement, and perhaps that will be done by the boards of the independent two companies separately. And we'll let you know in the due course of time.
And one last question is, how much time will it take to complete the TCNS merger?
So, we are awaiting directions from NCLT. That should come in this week. And in next 4 months timeline, Ankit, we are hoping we will be able to complete it.
Sure. Thank you so much and all the best.
Thank you. The next question is from the line of Ashish Kanodia from Citi. Please go ahead.
Yes, sir. The first question was on the debt built up on the lifestyle part of the business. So that business has been a free cash flow generating business, a very high ROC business. So just wanted to understand, when you look at that 1,000 crore kind of a number, if you can just give us a ballpark idea in terms of, what led to that number, and maybe, how much was for the inner wear business, and how much was for the, the core lifestyle brands?
See, Ashish, there is a prescribed formula which we have to adhere to if we have to qualify for the demerger. That is under section 219AA, which I explained to you. That section provides how the general corporate purposes debt needs to be allocated. That is in proportion to the total assets transferred to the total assets of the company. That's how this debt number is derived and vetted, and by the legal luminaries, those who are advising us on this transaction.
Got it. And maybe just the second question was, now tomorrow will be part of the ABFL post the demerger, and there is a plan to raise 2,500 crores of equity in the new entity, in the ABFL entity. But there was also a plan to raise external fund within tomorrow, because that was like a separate strategy, and that business might continue to need more capital than other businesses. So does that strategy still remain intact, or will there be any change in the tomorrow's fundraise plan given the demerger?
No, I think we have consistently maintained that tomorrow will have its own funding trajectory. We'll continue to run tomorrow as a separate independent entity which will raise its own capital, and that journey will continue. So this 2,500 that we are talking about is for ABFL. For its growth purpose, we'll separately continue to find the right time and opportunity to raise capital for tomorrow, which probably will be during the course of this year. So that's a separate funding plan for tomorrow.
Sure, that's very helpful. Thank you.
Is that we feel that the different nature of the businesses will attract different kind of investors, and therefore we want to clarify that and bring different stages of business to different sets of investors, and that clarity is what we are providing through this structure. Tomorrow is always to be funded separately, and that's the plan that we follow.
Sure, that's helpful. Thank you.
Thank you. The next question is from the line of Naveen Baid from Nuvama Asset Management. Please go ahead.
Yeah, thank you for the opportunity. So you said the new entity is likely to have debt of roughly about 1,000 odd crores. Just wanted to clarify that this does not include the lease liabilities.
No, this is the borrowings I'm talking about. Lease liabilities are specific to those assets, to this business that will come together.
Okay. Thank you.
Thank you. The next question is from Nisar Vakharia from NB Alpha Fund Management. Please go ahead.
Yes, sir. The reported EBITDA for Madura Garments comes separately as a part of the standalone business. There is a 176 crore reported pre-Ind AS EBITDA loss in the lifestyle brands. Now you have made it very clear that we are going to get Not Collective, and we are going to get Reebok and Van Heusen and American Eagle. Can we know an indicative number of the EBITDA loss that is going to come into the listed company, indicatively? In the new company.
So it's too early for us to talk about. I don't know which pre-Ind AS EBITDA loss, because we don't report pre-Ind AS numbers. And to that extent, I don't think this entity has a loss in this period. But I think if you have any further sort of clarification, you can talk to Amit subsequently, reach out to him. Besides, in this call, we are not giving any forward-looking numbers, and want to focus more on the announcement and the rationale.
So this is not forward-looking. These are the numbers which are existing in the business today. So you are saying that there is no EBITDA loss that we are doing in the
pre-Ind numbers that we have ever put down in the public domain for the last few years. So I don't know where you're getting the numbers from. That's why I'm suggesting reach out to Amit and clarify these numbers.
Okay. I'm done. Thank you.
Thank you. The next question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Good evening, sir. My first question is again on the 2,500 crore equity capital which you plan to raise. So just wanted to know, since you have mentioned that the promoter will also participate, is it fair to assume that the promoter participation would be equal to their current holding in the company, which is around 52%, just so that they can maintain their shareholding?
So I think, as we discussed in the previous couple of questions, the nature of the fundraise and the instrument that you'll use is not decided. I think from what our intent is, it's obviously that the entire fundraise will have very strong support from promoter. At this point of time, since this instrument is not decided, it will perhaps be speculative to get the exact shareholding and the nature of participation.
So instrument in the sense, but it would be an equity capital, either by way of QIP or a preferential or right or anything, but it will be an equity capital. So, so just wanted to know, is the promoter willing to maintain its current shareholding, or they are ready to dilute it?
Depending on the nature of whether it's rights, preference, something else, and therefore we'll have to decide at that point of time, and different shareholders will decide what the nature of it.
Okay, and my second and last question is the lifestyle business. Now, I remember a few years back when you had conducted a big analyst meet where you had articulated the next 5-year plans. So in that you had mentioned that in the lifestyle business, the potential of that business is to do around 1,000 crores of pre-Ind AS EBITDA by FY26. Now, and and definitely that's excluding the innerwear and the Reebok. So is it possible to achieve that kind of EBITDA now by FY26, what you have targeted at that time?
Again, it will be amounting to giving an estimate for next year numbers. I think at this point of time, we'd stay away from it, but let me reassure that trajectory in lifestyle brand over last 10, 15, 20 years has been fairly consistent, and the business has continued to track on the lines that we had indicated, and to that extent, there's robustness and predictability around that business. I don't want to give an exact number. We don't have it right now in front of us either, nor is that the purpose of today's call. But it's been a fairly stable business, which is growing at a fairly predictable rate and a very strong business model.
Okay, and any plans of that 1,000 crore debt which will be there in this business? Any timeline that would you like it to be a debt-free company in, say, in a couple of years, or you'll maintain, or that debt position will maintain? Because the free cash flows would be very good in that business.
Yeah, I think the cash generation ability of that company, that part of the business, although we'll grow the business more aggressively, and it has multiple growth opportunities, including Reebok, innerwear, apart from the 4 lifestyle brands, but it's a fair observation. We expect over the next 2 to 3 years debt to be significantly lower, if not complete zero, and I think that's the kind of trajectory we see for the business.
Okay. Thank you, sir. Thank you so much.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from Nishant Sharma from Nuvama Wealth Research. Please go ahead.
Hi, thanks for the opportunity. My question is more like a follow-up question to earlier participant related to the timelines. Sir, on the TCNS merger, are we yet to get shareholder approval from both the companies?
Yes, please. We have yet to see the direction from NCLT Only after that we will go to shareholders. So it is still pending. But hopefully, we are hoping that it should be done in next 120 days.
Okay, and sir, can we file? Can we file another scheme of arrangement with NCLT when one is already going on? Unless and until we get a final verdict on TCNS merger, can we file the new scheme of arrangement with them for this demerger? Is that possible?
In our scheme, we have said this is one of the condition precedents, and I think we are going with that assumptions because we are trying to complete this in next 9 to 12 months time. So first we will file with the stock exchange. After hearing from them, we'll go to NCLT. By then, hopefully, we'll have much more clarity about TCNS. So we kept it as CP in our scheme.
Okay, so for our demerger, the next process ideally would be filing with the exchanges, which I don't think so require the NCLT filing, or the first NCLT filing will be done, and then based on their recommendation, we will go for exchange approval and subsequently shareholder approval.
First, we'll go to stock exchange. Only after that, we'll go to NCLT, and then NCLT will direct us to hold the various meetings with the shareholders and creditors.
Okay. Thank you, sir. I'll fall back in the queue.
Thank you. The next question is from the line of Garima from Kotak. Please go ahead.
Yeah, thanks for the opportunity. One question, and this is mostly for the Madura business. Now that it actually has access to all of its cash flows, etc., can Madura itself become more aggressive with growth and think about more investments in the fields or various business segments that it is present in?
So I think, honestly, Garima, at this point in time, we think the Madura part of the new entity, which is Lifestyle Brand Limited, has multiple growth opportunity in the form that it exists in today, which is the 4 brands. Reebok is a very large opportunity in the broader sportswear space. It's very early stage, just a year from the time we have effectively taken control of the business. Innerwear business has a very long runway in front of it, and there are multiple brands that we could play that out in. The youth fashion is also a large space. I think our initial focus at this point of time is going to be on strengthening and accelerating the current portfolio that we have, which itself is both diverse and can grow much faster with that. And that will be the intent at this point of time. Of course, in the due course of that business, the board of that company may decide something else. But in the medium term, this is the strategy that we see going forward.
Understood. Thanks, Ashish. Now, in the ABFRL, the post-demerger ABFRL, where do you think most of this capital allocation will go to? Should we construe that most of this goes towards the ethnic wear business, which is the most sort of nascent part of that entity?
Yeah, I think amongst the portfolio, ethnic wear will take because particularly Tasva needs capital. Some of the designer businesses have very large growth ambition and possibility there. They will need some capital. So total put together, I think that will be the largest part of it. There is a one-time investment in the Galerie Lafayette first store that we are talking about. So luxury will take a little bit of investment. Value retail, while Pantaloons perhaps will generate enough to fund its growth, the Style Up would need next level of capital. And as the market improves, we have obviously planned to grow Pantaloons and Style Up portfolio also much faster. So I think all the 3 businesses in ABFRL will take capital, but the order perhaps may be ethnic, followed by value retail, followed by luxury.
Thanks so much for that. Those were my questions.
Thank you.
Thank you. Next question is from the line of Shrey J from Swan Investments. Please go ahead.
Hello. Thank you for the opportunity, sir. My first question is, sir, the 2,000 crores of debt that stands in Pantaloons business. So what is the timeline or the schedule, so to say, for the repayment of debt? And a related question to that is, what is our capital allocation sense in that business? Would we want to repay off debt, or would you want to chase growth in that business? So how do you look at this whole piece?
So the 2,000 crore debt is mix of long-term, short-term, and the working capital, Shrey. But it is, 3/4 portion, around 1,500 crore is more than 2 years, and rest all is at the shorter end. The second question is, where will we use this equity raise money? That is your second point?
So I think the capital allocation part that you talked about, it's very similar to the question that Garma had asked earlier. See, if you look at it, all the three businesses within this portfolio, whether it's ethnic wear brands, Pantaloons plus Style Up portfolio, which is the value retail, or the luxury, to lesser extent luxury, but between the value retail and ethnic wear, we have just acquired or launched multiple businesses, and the growth possibilities in each one of them are very large. So there will be growth capital which will be required to get these businesses to the level of stability and size that they become funding businesses, and that's really where most of the capital will
go. Okay. And secondly, sir, so we understand that you're targeting more the ethnic and then the others. But just what we wanted to understand is, would you be okay with a little bit of debt on the Pantaloons books, or looking at the past trajectory of a company, would you want to repay off debt and then chase growth? So just wanted some understanding on that. And second is on the Madura bit that comes in. So here also, would you want to chase growth in Reebok, or do you think the 4 brands that we have there, the larger portion of your capital will be deployed? So just some sense on that business as well.
And the second one, I think we've already talked about, Shrey, which is the 4 brands don't need much capital. Even to that extent, even Reebok doesn't need too much capital because it's mostly franchisee-led growth in small format retail. And to that extent, that entity will generate positive cash flow after pursuing all options of growth for itself. And therefore, it's simpler response there. In the ABFRL entity, which has multiple opportunities, we have obviously invested and carefully created this portfolio of ethnic wear, of value retail, as well as entered the luxury segment. The whole intent of the strategy, we'll have to play it out over the next 2-3 years for each of these businesses to become meaningfully large, competitive, and achieve their full potential. And to that extent, the whole idea of this fundraise is to continue that journey. And to that extent, if there is a small amount of manageable debt which sits in the company, that we'll have to manage.
Okay. All right. That helps. Thank you so much.
Thank you. The next question is from the line of Jasmine Surana from VT Capital. Please go ahead.
Hi. I wanted a little long-term view from your perspective. I wanted to understand, in case of any mergers and acquisitions that we might be doing in the long term, what would be your rationale, or what would be your view on deciding whether the business should come into Madura or whether the business should remain with the Pantaloons side of the segment? I wanted to understand how would we categorize those M&A opportunities, and if at all you feel the companies would be ready for M&A opportunities, which is still on your mind after the demerger.
So I think I'll repeat what I've said several times over the last couple of quarters, that we had a clearly laid out strategy announced 4 or 5 years back. We have executed that strategy, and as a part of that strategy at this point in time, we don't have too many white spaces which are large, attractive, or meaningful for us to look at it. And to that extent, the company is in a consolidation phase of making more out of what we have. But to your previous question, which is really how do we select which parts of the businesses lie where, clearly we have taken a path of value retail, which will lie in ABFRL, and luxury retail, which will lie in ABFRL. The only other thing that we have added here is the ethnic business, which is a combination of multiple formats that we have in that business. Very early stage, over the next 3, 4, 5 years, this will be a very large part of the business. It's, as I said, it's already ethnic wear is close to 2,000 crores annual annualized run rate. We expect it to be 4,000 to 5,000 crores in the next 3 years, and that's really the size of opportunity we want to build it. While Madura side will build largely Western branded small format businesses, and that's the kind of opportunity that we have created on that side of the business, and that's the path that we pursue there.
Thank you so much. Yeah.
Thank you very much. Ladies and gentlemen, on behalf of the management, we thank all participants for joining us. In case you have any further queries, you may please get in touch with Mr. Amit Dwivedi. You may now disconnect your lines.